Good morning and welcome to today's webcast, Tax Reform Implications for the Aerospace and Defense Industry. Before we get started, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Peter Henderson, Senior Manager, Kurt Lippmann, Partner, and Roy Deaver, Partner. And Kurt, I will turn the line over to you to get us started.
Thank you, Emily, and thanks for everyone for joining this presentation. I know everyone's got really busy schedules and lots going on in aerospace and also with tax reform, so we hope our presentation today brings some simplification for you and also value as it relates to your company and tax reform. So we did this presentation just as the flurry was happening at the end of 2017. And and we knew that the tax reform was going to occur, so we thought it would be really helpful, to update that presentation based on all the activity that's occurred in 2018, and now that some of the dust is settling, and we'll probably even need to do it later in the year, perhaps. So the agenda here, as it shows, we're going to have a little bit of background. That'll highlight some of the what's occurred since 2018 or during 2018, and then we have summarized some of the positives and challenges for as it relates to tax reform into 2 slides, and then Peter and I are going to jump into some of the business tax reform details. Roy will jump into the international tax reform details, and then we'll wrap up our presentation. So I think everyone's pretty familiar with the flurry at the end of 2017, and which ended with the signing of the Tax Cut and Jobs Act into law on December 22nd. Now, what may not be as familiar is just what's happening in 2018. So this next slide is we could probably add a dozen more bullet points to the timeline. And, for example, international has a whole bunch of, notices and guidance and frequently asked questions that came out So just in 2018, there's been a flurry of regulations, guidance, frequently asked questions, notices, revenue procedures. So there's all this activity related to trying to digest the tax reform, and it's going to continue for the rest of 2018. And here we just wanted to highlight there's a lot going on, and that will continue. But we are going to, what we know to date, we will share through this presentation. So starting with just you could use these next two slides as summaries of what we feel like we take all of this data and this information and how does it apply to aerospace companies. And we wanted to summarize in an easy two slides generally what we see are the tailwinds and the headwinds. And so on the tailwinds, we'll go into a lot of this detail in the coming slides. But a couple of them we did not have time in this hour, so I want to highlight right now. One is the retained foreign export incentive, the IC DISC, which is a domestic international sales corporation. A lot of the organizations in aerospace use that incentive, and it's been a great permanent tax savings. It did not go away with the tax reform, and which was fantastic. The only thing that did occur was that because the rates, the individual tax rates and the corporate tax rates went down, the permanent difference or the permanent incentive did diminish, but still a permanent difference is very valuable, and there is a lot of value still with the DISC. The other one is related to the estate and gift exemption. It went from $5 million to $10 million per person, and that's going to sunset in 2025. I really feel like that this is going to be a significant planning area, and especially for estates that have significant value. And it'll go back to $5 million per person. So there's a significant area here just related to your entity type that you choose going forward, and also just the estate planning that you need to do for the owners and shareholders of the aerospace companies. Okay, going into some of the headwinds, there's a list here of several of them. I'm going to highlight a couple again because we're not going to go into detail on them. But one of those is the new loss limitation rules for flow-throughs. So what happens here is, I'll do a quick example, but if you had a flow-through loss of $2 million from your flow-through entity and you had other ordinary income on your 1040 of $2 million, normally under old law, those would have netted and you would have had zero net income. Under new law, you're going to be limited on that, how much of that $2 million you can use. And if you're married filing joint, you can only use $500,000 of that $2 million loss. So you would end up with $1.5 million net or taxable income on your 1040. And so that's a real simple example, but that's a significant difference. And what happens is that loss that you did not use becomes a net operating loss going forward. Another one is just the new rules related to sale of intangibles. So this really is going to impact M&A transactions and the sale of an organization. And what they changed was what is a capital asset, and self-created patents, inventions, your designs, and secret formulas and processes are no longer considered a capital asset, so those will be considered ordinary income. The impact there that really needs to be taken into account is basically when you are selling an organization, how you do your purchase price allocation, and also when you do valuations, how you navigate what the value is of those self-created intangibles now, because they would create an ordinary income. One last one that I want to mention before diving into some of the business tax reform is related to like-kind exchanges. So like-kind exchanges were under old law related to real and tangible personal property. Now what has happened is now it's just for real property. So a lot of aerospace companies would exchange their machinery out, and any gain on the exchange of the machinery for a new one would be deferred. That gain now will have to be recognized going forward under new law. And some of the offset of that, though, will be that you can expense 100% of that new piece of equipment under the new bonus rules that we'll talk about later. Okay, so we have our first polling question, and Emily was going to run with that.
All right, our first question. Overall, what impact are you seeing now from tax reform for your organization? And your options are mostly positive, somewhat positive, no impact, somewhat negative, or mostly negative. I'll give everyone a few moments to make a selection. To participate in our polls, please click the button next to the answer you choose and hit submit. And if you aren't seeing the poll, you might want to try refreshing your screen with F5. And I'll give everyone another moment. And let's take a look at the results. Kurt, back to you.
Thank you. So that's expected. So generally we see this all adding up, tax reform to being mostly positive, and 31% was mostly positive and somewhat positive. So taking those two, that's over 60-some percent. And that makes sense to me. I think generally the takeaway is that there's a lot of positiveness. Peter, do you want to take the next slide?
Yep. All right. So hopping into business tax reform, one of probably the most significant changes that came from tax reform was the reduction in the corporate tax rate to 21%. This replaced the previous maximum tax rate of 35%. It's important to note that this new 21% rate is a flat rate, whereas the previous rate was a gradual rate with a maximum of 35%. The other big change here is the fact that the corporate AMT was repealed, and we'll talk more about that later on. But diving into this a little bit more, we won't spend a lot of time on this, but there are a few things worth mentioning. And the first one is that we just want to make no mistake that the reduced corporate tax rate and the repeal of AMT is highly beneficial for C Corp aerospace companies, as that polling slide showed. But you do need to consider this in conjunction with the fact that we did lose certain key tax incentives as part of tax reform. Another key consideration is that companies with foreign operations, so multinational companies with foreign operations, will experience some complexity related to the repatriation of foreign earnings and the new international tax provisions that Roy will be talking about. And another key thing here is that fiscal year filers are going to need to use a blended rate for the transition year. And the transition year is defined as the year that has the day January 1st, 2018. So this blended rate is going to be based on the number of days before January 1st, where the old rules are going to apply, and then the number of days after January 1st, where the 21% rule is going to apply. Then we just got kind of an interesting fact here, which is that the aerospace industry generated $45 billion in tax revenues in 2016. And I would guess that this number would probably be significantly higher in 2017, given the state of the industry. So next up, Kurt is going to be talking about the 20% deduction for pass-through businesses.
Thanks, Peter. All right, so like Peter said, now we're jumping from C corporations to flow-through and individual side, and just like on the corporate side, the C Corp side, there was a rate reduction there. There's also two forms of rate reduction on the individual side. One is just the individual tax rates were broadened, and also the high was 39.6. The highest bracket was 39.6, and it went down to 37%. In addition, for flow-throughs, there's an additional 20% deduction on qualified business income. And there's been a lot of discussion about this, and it's also very valuable and significant rate reduction. And so basically it's taking your 37% high down to a high of 29.6 with this flow-through deduction. Now there's lots of pieces to this, but a simple example would be if you had a qualified business that made $100 and they would be taxed on 80 because they would be allowed a 20% deduction, and that 80 would be taxed at 37%, which equates to 29.6% effectively. So there are limitations on the say the $20 deduction that you get to take advantage of. So one thing that the $20 cannot exceed 50% of your trade or business W-2 wages. So you have to have the W-2 wages in order to take the 20% deduction. And the great news there is that proposed regulations were issued in this month, in August, and those regulations are providing for grouping elections that can be made. So if you have multiple flow-throughs and maybe one of the flow-throughs has the lot of income but doesn't have wages, but another entity doesn't have as much income and has the wages, then you can bring those two together and do grouping elections. This is getting digested right now because they were just issued, but in general, it looks like there's flexibility, and a lot of the concerns that were raised are being addressed with the regulations. So that is good news. The other good news for aerospace related to the 20% deduction is it wasn't going to apply to service businesses, and typically service businesses in the past has included engineering companies or engineering focused businesses, but they made an exception, and engineering businesses are considered a qualified business. So good news there for all the engineering companies out there in the aerospace sector. So the next two slides we have here is you have these rate reductions that are very significant for both C corporations and flow-throughs. So which entity is the best? And what we did is we provided a very simple example here on this slide, and it doesn't have any state implications. It doesn't have international implications. And what it says is that if you are distributing all your earnings, whether you're a C or an S, to the owners, and you qualify for the 20% deduction, which we think most of the aerospace industry should be able to, then you are better off being an S corporation in this example. You would end up with a flat or combined effective tax rate of 29.6 versus in a C corporation, it would be a combined effective rate of 38.96%. So that's, again, a very simplified view. And so the next slide here is us just brainstorming on when you do your analysis on which entity is the correct or the best for your organization, what are the questions you should ask? For example, how will after-tax earnings be used? If you're going to distribute all of your earnings out, then probably that's going to be a significant factor for staying or being an S corporation. Also, we put on here some considerations that you can look at. Timing of your exit strategy, that would be another significant consideration, because if you're going to sell your company soon, which is a lot of consolidation is occurring in aerospace, then what you would want to do is probably be in a flow-through environment where there's a single level of tax, and that's not in all cases, but in general you would want to be where you're assured a single level of tax. All right, now we're going to jump into some of the AMT details with Peter.
All right, thanks, Kurt. So we'll start off with AMT for C Corp, and as I mentioned, that was completely repealed. The AMT for C Corps is repealed, And repealing this has been really a key goal of the tax reform since the start. And it goes hand in hand with the reduced corporate tax rate. For the corporate tax rate to go down to 21%, they really needed to repeal corporate AMT. And the reason is that if tax rates were lowered to 21% and the corporate AMT remained in place at 20%, companies would just end up getting caught up in an AMT and not being able to take any other credits or incentives. So eliminating the corporate AMT really allows companies to take full advantage of that 21% tax rate. Another related benefit here is that AMT credit carry forwards going into 2018 tax years are now refundable. And so previously AMT credits could only be used to offset regular tax, but they made an exception to that. Now any companies that has AMT credits but is in a taxable loss can cash in on those credits and get them as a refund. There is a limitation of 50% for 2018 through 2020, and then it becomes 100% in 2021. So switching over to the individual AMT, this was not repealed. It is still in place, but they did make some changes to it that watered it down a bit. And the AMT, the individual AMT, has always allowed for an amount of income that is automatically exempt from AMT. And then that exemption amount got phased out at what many considered relatively low income levels that needed to be updated. And so the way that this new AMT has been essentially watered down is that first, the amount of income automatically exempt from AMT, or the exemption amount, has been increased by roughly 30%. So it's now up to about $110,000 for individuals married filing jointly. The second aspect of it is probably more important, and that's that this phase out of the income exemption has been increased by about 600%, and it's now up to $1 million for married filing jointly. So what this all means is that while the individual AMT is still in place, fewer individuals will be subject to AMT, and those that are paying AMT will likely pay less than they otherwise would have, as long as their income is less than $1 million. So switching over to accounting methods. So there were some changes related to accounting methods that we're going to talk about. One of the key changes here is that the threshold that exempts certain taxpayers from the requirement to use the accrual method of accounting has increased from $5 million to $25 million. So this means that companies with less than $25 million in gross receipts now have the option to use the cash method, opposed to just being limited to the accrual method. And as a result, we do expect to see a number of taxpayers switching over to the cash method this year. Another one is that sorry, go ahead, Kurt.
Oh, I was just going to mention that RevProc 2018-40 was also just recently came out, and it is also very taxpayer friendly as far as making those method changes you were discussing.
Right. Okay. The next one is that the threshold for the exemption for UNICAP rules has also increased to $25 million. And that means that companies with less than $25 million in gross receipts do not need to comply with the UNICAP rules, which can be fairly complex. And a third one is that the threshold for the requirement for taxpayers to use the percentage of completion method for long-term contracts has increased, and that went from $10 million to $25 million. And we think all three of these categories, these key changes here, could be very beneficial to those small to medium-sized aerospace companies, since a lot of them do carry high inventory and a lot do have long-term contracts. Then there's one last change here that relates to revenue recognition. This is not necessarily a favorable change like the others, but it's essentially requiring all accrual-based taxpayers that have audited financial statements that they now need to recognize income for tax purposes no later than it is recognized for audited financial statements. Whereas the previous rule was that it's recognized once it's fixed and determinable. There's one specific opportunity that we wanted to mention here, and it relates to tariff and the use of LIFO. So there was quite a bit of speculation that the use of LIFO, which is last in, first out inventory accounting, that it would be repealed as part of tax reform, but it wasn't. And so this could present an opportunity for companies that are seeing a large increase in their raw material costs as a result of these tariffs. So these tariffs, as many know, they were put in place early last month, and it includes a 10% tariff on imported aluminum, a 25% tariff on imported steel. And even though most aerospace or many aerospace companies do source their raw metals domestically, the cost of raw metals, domestic raw metals, has gone up significantly as a result of the tariffs as well, just due to the law of supply and demand. So adapting LIFO would just allow these companies to accelerate the deduction, associated with these higher cost, the higher cost inventory, currently as cost of goods sold. And so we think this could be a good opportunity specifically for machine shops and other aerospace companies that keep large inventories of metal. And this is likely if a company is looking to pursue this, it's likely going to be most beneficial for the 2018 tax year, maybe 2019, before inventory fully turns over. But as long as inventory costs are increasing, it will continue to be a benefit. All right, that brings us to the next polling question, which is, actually, Emily, are you reading these? Or?
Yeah, I'll take it. Okay. And this is our second polling question. How have the tariffs impacted your company's cost of materials since they took effect in July? And your options are no effect, minor effect, or major effect. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I'll give everyone another second here. And let's take a look at the results. Peter, back to you.
All right. So, and these are as we expected. It's going to have a major effect on certain companies that do purchase a large amount of raw metal stock. And also it may have not, it's probably not something that a lot of companies have yet seen the results of because it is so fresh. It did just take effect early last month. So it's going to take some time to really, for companies to really see the effects of that. So let's see, next up we've got, we're going to be talking about increased cost recovery incentives. And this was another hugely beneficial aspect of tax reform. And namely, the new rules related to bonus depreciation allow for 100% expensing of qualified property, whereas the previous rules just allowed 50%. So in addition, the new rules also include both new and used goods opposed to just new goods under the old rules. Another big one here is that the Section 179D deduction has been expanded by increasing the expensing limit from $500,000 to $1 million, and they also raised the phase out of that limit. So overall, we do expect that these will have a very positive effect on the aerospace industry, and that's just due to the high volume of fixed assets purchased by aerospace manufacturers. So companies are now able to deduct 100% of the cost of new machinery and equipment, such as CNC machines, robotics, and everything else. One thing that's worth mentioning is that there is another way to accelerate the deductibility of assets of real property, and that's through cost segregation studies. So cost seg studies, they break out the individual building and leasehold improvement components, which were initially categorized as real property and subject to a very long depreciable life of 39 years. And they break it out into components with much shorter depreciable lives, thus allowing you to accelerate the deductibility of those items. And this tends to be a very beneficial incentive for aerospace companies due to the fact that the manufacturing operations generally require large, expensive buildings and facilities. So Kurt is going to be talking about the business interest deduction.
All right. So this one is not a positive. It's a headwind. And basically what's happening here is most organizations, unless they've had foreign-related party interest, are used to deducting all or 100% of their interest expense. And what the new law did is said that there's a limitation related to how much of your interest expense you can deduct. And that is basically 30% of your adjusted taxable income. So what's important to understand is that through 2022, how you figure out your adjusted taxable income is basically like an EBITDA formula. So you can add back your earnings before interest, taxes, and depreciation and amortization. So, hopefully that will keep a lot of people out of this limitation by having all those add backs through 2022. But if you are, and you are limited, then what will happen is that becomes a carry forward. You don't lose it, but you will need to run the calculations each year to see if you can utilize your current year plus what you have carried forward. So a takeaway here is that, again, before 2022, it's an EBITDA type analysis, and then take 30% of that adjusted taxable income. But after 2022, it gets more stringent, and it's a EBIT calculation, so it's earnings before interest and taxes, so you don't get to add back your depreciation and amortization. So there's a lot of lobbying to try to see if that can get changed, because at that point it feels the industry does feel like it's going to have a fairly significant impact, especially with private equity and larger multinational firms. So one thing is to review the applicability of this new headwind here, but also maybe consider some of your options related to your debt, whether you can restructure it. It can go into a form that looks like debt, but it is not defined as debt for tax purposes. Okay, so net operating losses is the next slide here, and want to move and just explain that the old law was basically 2 years back, 20 forward, and now we have a new law, and basically you don't get to carry back, which is significant. And it's all carry forward, and when you do carry forward, you only get 80% each year of that NOL carry forward to be utilized. So the impact is likely a cash flow impact to be aware of. And then I think the other aspect of it is if you feel like it looks like you're going to have a net operating loss in the current year under the new rules, would you want to modify? For example, Peter just covered all of the enhanced expensing opportunities with fixed assets. Would you want to elect out so that you don't have a net operating loss? Okay, Peter, next slide on special interest provisions.
Yep. All right. Thanks, Kurt. So one of the key selling points of tax reform was that they were going to simplify the tax code by eliminating various rules and incentives, and then also lowering the tax rates to compensate. And one of the key incentives that was lost that relates to aerospace companies is the domestic production activities deduction, also called DPAD or the 199 deduction. And this is an incentive that gave businesses an extra deduction for producing goods in the U.S. and it was very popular for aerospace companies, aerospace and defense companies, just due to the large volume of very high dollar goods that are being produced in the U.S. So that was definitely a hit, and there were various other incentives that were repealed that are relevant to aerospace companies. But fortunately, the R&D credit was fully sustained, and so we'll dive into that a little bit more. The R&D credit is considered by many to be the single most beneficial incentive out there available to aerospace companies, and that is especially true now in light of tax reform. So while the R&D credit did not undergo any changes as part of the tax reform, there were a number of other things that changed which had the effect of making the R&D credit even more valuable. And just some background on the R&D credit, it's a credit that provides a cash benefit, so a dollar-for-dollar reduction in taxes, which is commonly around 15% of your qualified expenditures, and that's when you're considering including both the federal and the corresponding state credits. And in general, a lot more will qualify as a qualified expenditure than many people often assume. The credit can apply to all types of aerospace companies, from OEMs all the way down to the lowest tier suppliers. Even small machine shops that are doing build-to-print jobs oftentimes will incur qualified expenses. So on to what made this credit more valuable in tax reform was the repealing of the corporate AMT and the watering down of the individual AMT. So AMT has historically been a big limiting factor for the usability of R&D credits. So that will no longer be an issue on the corporate level, and it'll be less of an issue on the individual level. Another thing to mention is that the lower tax rates have actually made the credit more valuable. And the reason is that this credit is essentially considered taxable income. So it gets added back into income, and you end up paying taxes on it. So if we take a $100,000 credit, for example, adding this back into income at a 35% tax rate will ultimately give us a $65,000 net benefit, whereas adding it back at a 21% tax rate would result in a $79,000 net benefit. And also probably worth noting that just with the lower tax rates and the fact that the credit rates on the R&D credit remaining constant means that it can take a bigger chunk or a bigger bite out of your overall tax liability. So a lot of very favorable things there. One thing that's not so favorable is that beginning in 2022, research costs must be capitalized and amortized over 5 years, whereas previously they could be expensed immediately under Section 174. And this has been a very unpopular provision, and it's possible that things could change before it actually gets put into place, just because there's a lot of pushback from large companies on this. But as of now, there is a requirement to capitalize and amortize R&D costs over 5 years, beginning in 2020. So that brings us to the next polling question.
All right. Our third question, do you currently take advantage of the R&D credit? And your options are yes, no, or I'm not sure. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts, which is to the right of your slide view. And we'll also be sending the slides via email after the webcast. Give everybody a few more moments to make a selection. And let's take a look at the results. Back to you.
All right, so it's fairly split, which is a bit surprising. As I mentioned, this is a very lucrative incentive that is very applicable to aerospace. So for those that aren't taking it, they should definitely look into it. So next up, we've got Roy, who is our international tax leader, and he's going to be diving into some international tax provisions.
Thanks, Peter. So we're going to talk about a couple of the international tax changes that came into place. There's been a lot of talk in the press how the U.S. is moving to a territorial system, and in some ways it is, but in many other ways it really isn't. It's actually going more to a full inclusion system, which we'll get to in a minute. The first big change is actually one that will affect most taxpayers for their 2017 tax year. So a lot of the changes that Peter and Kurt have been talking about have been prospective, or at least starting with this tax year, prospective at least when tax returns are filed. But there is a change that, like I said, most taxpayers will see on their 2017 tax returns to the extent that they own foreign entities or have any investments outside the U.S., and that's the transition tax. And this provides the mechanism for the U.S. to move to that quote-unquote territorial system by taxing all unrepatriated earnings at a one-time rate, and that rate being reduced rate somewhere between 8% to 15.5%. And the difference is it depends on the assets being held by the foreign entities and how liquid those assets are. The more liquid assets that those entities hold, the higher that effective tax rate is going to be. It's going to get closer to that 15.5%. The amount is not that there isn't a tax that's computed at that rate. Rather, there's a gross inclusion of those foreign earnings, and then there's a deduction, a corresponding deduction that's calculated based on those rates. For individuals who own foreign entities, either directly or through a pass-through entity, those rates actually tend to be a little bit higher because the deduction amount is calculated based on the corporate rate of 35%, whereas individuals can be taxed as high as 39.6% for the 2017 tax year. The way that the liability on these earnings gets calculated, it's you compute your tax liability with the net inclusion, and then you compute your tax liability without the net inclusion. And then the difference between those two amounts is your 965 liability that you then get to elect to pay fully with your 2017 tax return, or you can elect to pay it ratably or pay it over 8 years. That 8-year election is not a ratable payment. It gets backloaded into the back 3 years. So it's 5% of the total liability for the first 6 years, 8% of the total liability for the first 5 years, and then 15, 20, and 25% of the liability in the last 3. So it really gets, like I said, kind of loaded back into those past years. Individuals do not get any sort of foreign tax credit for the underlying taxes paid by the foreign entities, whereas a C corporation will, and that C corporation can then reduce their overall liability by those foreign tax credits. An individual, though, as long as they own 10% or more of a foreign corporation, either directly or indirectly, can make an election to be taxed like a corporation to take advantage of those foreign tax credits. Whether that is advantageous for an individual to make that election is dependent upon a number of factors, which may include whether there's a plan to dispose of the entities in the future or take back distributions. One of the other things is that the full amount of the inclusion, the amount without the deduction, is subject to the net investment income tax, or the 3.8% tax on passive income. So that's another item that needs to be factored into the computation as well. If you're an S corporation, your shareholders can make an election to defer paying the tax. So everybody has the opportunity to pay the tax over 8 installments, but S corporation shareholders can actually elect to defer as to when that 8-year period starts. And that deferral lasts until there's a triggering event, which is either that the S corporation no longer is an S corporation, the company sells all of its assets, or the shareholder sells their shares in the S corporation. At that point, they then can make the election to pay over the 8 years. That's the triggering event that starts when the liability will start. To the extent that the shareholders make that election to defer, the corporation needs to understand that they now become jointly and severally liable for that liability. So to the extent that the shareholders don't pay their 965 liability, the IRS can come after the S corporation to collect that amount. So that needs to be something that the company needs to have conversations with their shareholders to understand who's making the election and making sure that they pay that when they have a triggering event. Also, for anybody that makes the 8-year deferral election, there are a number of triggering events as well that can accelerate that timeline as to paying any remaining outstanding payments that need to be made. And again, these mainly are around the sale or cessation of the business that can require any unremaining payments to be due immediately. Now, this is the area, again, given the immediacy of this is the area where we have seen the most guidance being issued by the IRS. So there have been several notices as well as proposed regulations that talk about the implementation of these provisions. Some of these have been taxpayer favorable. So, things for kind of administrative ease, like using a common exchange rate, a shortcut for calculating earnings and profits at November 2nd, and an administrative relief for no acceleration of installments if the first one was underpaid and was not due to negligence. While there have been other kind of provisions that have not been taxpayer friendly, the main one being that if a taxpayer overpaid their first installment or has a refund from their 2017 tax return and has a 965 liability in which they've agreed to pay in installments, then that overpayment or that potential refund is applied first to any outstanding 965 liability, including those that may be due in future years, rather than being refunded to the taxpayer. So that has caused quite a bit of a stir amongst the community in terms of being able to get those 2017 refunds. That's not available if a taxpayer has installments still due under Section 965. So that's something to keep in mind and to think about as that's being looked at and planning for cash flow purposes. One of the other key points in this is that the 965 liability, when you're doing your with and your without computation, does not create any sort of AMT. It's AMT is excluded from this, so that's also a good one. The other piece is that you can use your NOLs to offset the amount, and actually you need to elect out of not using your NOL. And so again, there was some initial thought, well, if I'm going to only pay tax at 15.5 or 8%, and my NOL is worth 21% in the future, why would I, use my NOL? But again, the way the computation works is, the analysis is a little bit more nuanced than that, given the way that the computation works, because again, it's a full inclusion followed by a deduction. And so again, that net amount is still taxed at regular tax rates. It's trying to achieve those effective tax rates. So it's a little bit more analysis that needs to be done, whether it makes sense to use your NOLs to offset the 965 liability or not. The main thing, again, with the 2017 tax returns, and that there are elections that need to be taken into account as well. If you're an S corporation or an LLC, some of those elections are made at the entity level, while others are made at the shareholder level. And so those elections cover things on ways to compute earnings and profits, the deferral election, the NOL election is if you're going to opt out of using your net operating loss to cover the liability, as well as certain basis computations for your tax basis in your foreign entities. So why I say that the U.S. is not moving to a territorial system is really because of GILTI, or the Global Intangible Low Taxed Income. GILTI is really a full inclusion system which requires a taxpayer to include all of the net aggregate earnings of their foreign entities that exceed a 10% return on depreciable tangible assets. So, if you have manufacturing or production facilities outside the U.S. and you have, significant capital investment, that may help mitigate that. But if you just have engineering support or other sales support or other type of activities outside the U.S. that aren't as capital intensive, almost all of those earnings are going to be included in the U.S. tax return. And the way that the computation works is that for a C corporation, it's meant to impose an additional U.S. tax on a company's foreign earnings if those foreign earnings aren't subject to at least 13.125% effective tax rate. That applies till 2025 when some of these benefits or some of the computation items change. After 2025, then the foreign effective tax rate that is being targeted is 16.4%. However, that kind of presupposes that a company, a C corporation, is able to fully utilize all of their foreign tax credits, that they don't have any type of limitations because of expense allocation or overall foreign loss, and have sufficient taxable income to be able to use all those foreign tax credits. To the extent that there are those types of limitations, or taxable income or domestic income is at a loss, that can create issues and actually result in additional U.S. tax under these GILTI provisions. The other thing, too, is that non-C corporation owners of CFCs are hit the hardest on this because, one, they don't get the 50% reduction of the inclusion. So a C corporation owner only has to include 50% of that income in taxable income, whereas a non-C corporation has to include all of it. The other part is that there's no foreign tax credits available for the foreign taxes paid on those earnings during the year. Now, again, an individual can make an election to be taxed like a corporation, to be able to take advantage of the foreign taxes as a credit. But again, that has to be an analysis that's done on a year-to-year basis to determine whether or not that makes sense or not. The other part, too, is even if these earnings are subject to a high effective tax rate, that just offsets the U.S. tax on those earnings. It doesn't provide any additional benefit to the U.S. company because those taxes or those excess credits that exceed the tax on that inclusion can't be used either on a carry forward or carry back basis, or they can't be used to offset any other foreign source income of the entity. So again, this is just a mechanism to calculate whether there's any additional U.S. tax on the foreign earnings because those foreign earnings weren't subject to high enough tax outside the U.S. All the other traditional Subpart F or deemed dividend provisions were retained. When we did the presentation back in December before the bills were finalized, there was some talk that the investment in U.S. property rules would be repealed, but those were ultimately retained pretty much last minute. That was one of the very last changes that came in over the weekend before they passed the bill. So in 2018, this will be an issue that all taxpayers that have foreign subsidiaries are going to have to calculate with, and this may result in, thinking through tax structures and whether there needs to be any changes made to tax structures to take into account this new full inclusion provision. And finally, there were some other provisions as well that were passed. I'm going to go over real quickly. The first is the Base Erosion and Anti-Abuse Tax, or BEAT, as it's referred to. Under these provisions, if a C corporation has average annual gross receipts of at least $500 million or more over the past 3 years, and a base erosion percentage of 3% or higher for the tax year, then they're subject to this. This is basically a new computation of alternative minimum tax. I know Peter said that the traditional AMT was gotten rid of. This effectively replaces it. So under BEAT, a taxpayer recomputes their taxable income disregarding any deductible payments made to a foreign-related person, and then applies a tax rate, a new tax rate to that. For 2018, that tax rate is 5%. It's 10% for 2019 through 2025, and then 12.5% thereafter. Those deductible payments are, things such as interest, royalties, that sort of thing, but also includes any purchase of depreciable or amortizable property from a foreign-related person, and those that payment will also get caught up into this computation. So as Kurt said, the DISC benefits are retained, and as Peter noted, the DPAD was repealed, but to replace the DPAD and to effectively provide a DISC-like benefit to C corporations, there was introduced the foreign-derived intangible income provisions. What this does is it gives C corporations a deduction for goods that have been exported or services provided or royalties collected from non-U.S. persons. This deduction is effectively equivalent to a 13.125% tax rate on that income for years up to 2025. From 2025 and after, it's a 16.4% effective tax rate. One thing to keep in mind in that we talk about with our clients as we're talking about structuring to take advantage of this benefit is that this may be challenged by the WTO. I believe that they've already made some noise about potentially saying that this may not pass muster under kind of agreed upon global trade rules, that it's providing an export subsidy. So it is something that may have a limited shelf life, but again, depending on the facts and circumstances, may provide a benefit in the short term. The hybrid rules, what these rules provide is non-deductibility of amounts paid for royalties or interest to the extent that the foreign recipient does not recognize that an income under their local country tax rules. In this case, then, the U.S. is going to deny that deduction. Some other changes that came into play, there used to be an exception if assets were transferred outside of the U.S. and those assets were used in an active trade or business. That was non-taxable. There were some foreign tax credit changes regarding foreign branches, and we're also looking at and otherwise anticipating additional guidance coming out under GILTI, FDII, previously taxed income, and basis and CFCs, as well as the election for individuals to be taxed as a corporation. And with that, I'll turn it back over to Emily for the last polling question.
All right, thank you. And our last polling question, given the change in tax on repatriated earnings, do you anticipate bringing more money back to the U.S. than you have historically? Your options are yes, no, or you're not sure. Give everyone a few moments to make your selection, and once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. And let's go ahead and take a look at the results. Back to you.
Thanks, Emily. I'll move to the wrap-up, so that's good information on the repatriation. And since we're tight on time, I'll just advance it here. And first of all, just thanks everyone for attending the presentation, and hopefully there was value provided. And I think I would encourage everyone to take inventory, basically, and review the tailwinds and headwinds, and do some mock modeling of how tax reform impacts you. I think hopefully everyone's on the positive side of tax reform, and I think the intent is that organizations if they're on the positive side, then they can either hire additional folks or do additional research and development, or spend those dollars for gaining more market share. So hopefully it's a positive impact, and we look forward to doing future presentations. Thank you.
All right. Thank you, Kurt and Peter and Roy, for a great presentation today. If you had any questions for our presenters, you may still submit those into the Q&A window, and we will follow up with you after the webcast. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.